in a world of uncertainty, what monetary regime are we entering now? Because it seems like the old one is dead. Bitcoin is most sensitive and most reactive to these fiat liquidity changes. And that's what I think was the 30% upswing recently, is financial authorities coming out and saying, we recognize the volatility, we recognize the chaos, we recognize the underperformance in what was supposed to be a safe haven. We're going to come print the money. We're going to come to value the dollar and support markets. And Bitcoin ran from there.
Jack Mallers is sounding the alarm on a major paradigm shift, and it's one most investors are still missing. While Wall Street and the mainstream media remain fixated on Jerome Powell's interest rate decisions, Mallers urges us to look beyond the headlines. The real source of liquidity isn't coming from the Fed anymore. It's flowing from fiscal policy and strategic Treasury actions. He credits Scott Bessent for playing a key role in stabilizing markets, using tactics like telegraphed stock buybacks and Treasury-backed financial support to keep confidence intact. And here's the kicker. Bitcoin hasn't been rising despite rate hikes. It's been rising because markets have figured out where the money is actually coming from. That's the signal most people are missing. This is the kind of insight that can shift your entire perspective. So if you're finding value here, don't just watch, smash that like button, hit subscribe, and turn on notifications so you never miss a beat. Got thoughts on where liquidity is really coming from? We want to hear them. Drop a comment below and join the conversation. And if you're serious about staying informed, watch our other videos on the channel. We're covering everything from crypto fundamentals to macroeconomic trends that impact your portfolio. Thanks for tuning in. Now, let's get into it.
How the US is going to afford to run this country with such massive amounts of debt, such massive amounts of deficits. The Fed doesn't matter. This idea of post 2008, where QE is the word everyone is looking for. I mean, this doesn't matter. What matters is the US is structurally short bond volatility. That's what I think we should really be talking about. Who's the marginal lender to the United States of America? And as soon as the MOVE index got above 140, and as soon as the bond market got volatile, every single market fell apart, and they stepped in and they said, we're here to bail it out if we need to bail it out. And that's coming from Scott Bessent. That's about financing the deficits. That's an extension of what Janet Yellen was doing in the last administration. That's where the liquidity comes from, in my opinion, not the Fed. Bitcoin went from 15,000 to 100,000 while Jerome Powell hiked rates. It does not matter what the Fed is doing. I think this QE is old news. Main Street knows what QE is. They can't tip off Main Street that way. I think the liquidity comes from the Treasury, and that's who we need to watch right now is Scott Bessent. You know, my mental model for Bitcoin is Bitcoin equals technology plus fiat liquidity. Technology in the thesis and the idea that we're going to continue as humans build advancements in technology. Things like cryptography, distributed networks are going to be positive signs for the world, plus fiat liquidity. Plus, the more currency they print, the more they weaken fiat currency. I think Bitcoin's the most sensitive asset to that. It's the most fixed asset in the history of our species. It's the most accessible smoke alarm to fiat liquidity. I think it's the direct response to money printing. I think Bitcoin smells it. And what we've seen the bond market was falling apart, dollar down, stocks down. And we saw Bessent and financial leaders come out and say, we will print the money. We're going to print the money. And I think Bitcoin reacted the most to that because it's the most sensitive. So I think in a world of uncertainty, what monetary regime are we entering now? Because it seems like the old one is dead. Bitcoin is most sensitive and most reactory to these fiat liquidity changes. And that's what I think was the 30% upswing recently, is financial authorities coming out and saying, we recognize the volatility, we recognize the chaos, we recognize the underperformance in what was supposed to be a safe haven. We're going to come print the money. We're going to come to value the dollar and support markets. And Bitcoin ran from there. I think Bitcoin, again, Bitcoin equals technology plus fiat liquidity. And that fiat liquidity part is so important. Who's the best expression of currency debasement? What instrument is going to react and punish more dollars printed? If this market is full of levered hedge funds and banks begging for leverage rule changes, and it's going to be more credit, more liquidity, more debasement, what do I want to own? And in my opinion, Bitcoin is the one that increasingly is checking that box. And by the way, gold failed us already. I mean, the biggest question for gold investors is this time different? Because the problem is all of the gold is sitting in Western nation state vaults. And that's what screwed us last time, is that in order for gold to actually be a global reserve currency, it has to be concentrated with government. And at the end of the day, when government wants to act not in your best interest, you're screwed. And that was the divorce of the gold standard and that Nixon shock. And so I think Bitcoin checks all boxes. It solves the problem that gold seemingly couldn't. And it's increasingly becoming the best expression of the biggest problem today, which is how are we going to enter a new monetary regime? How is the US going to distance itself from the world reserve currency? How is it going to deal with the structural deficits it's built up over the last 100 years since the world wars? And I think Bitcoin's won that bid. It's been the best performing asset. It will continue to be because it physically holds those properties. It's the scarcest thing you can own and hold yourself. What does the world do with the time and energy, the value, the trade, the surplus? Where do you put it? Where's an asset that is physically protective, that can't be inflated, that can't be controlled? Gold and Bitcoin. So you're seeing capital flows being reorganized, being reordered. The US saying, we don't want to be the world reserve currency anymore. It puts us structurally in a deficit. And the last thing I'll say is on the US's structurally short bond volatility, who in their right mind, Jeremy, would lend money to someone who can't control how they spend and is already in $36 trillion worth of debt? That's the United States. They run an unprofitable business, so they can't sustain themselves. They need a lender to finance their ability to survive. Who in their right mind is lending? And guess what? It's not China anymore. It's not Russia anymore. It's none of our global trade partners. It's hedge funds in the Cayman Islands and it's stable coins. If you look at the recent data, the biggest buyer of US debt has been the Cayman Islands, not because of the country, but it's because of hedge funds domiciled there. And so the reason the US can't afford volatility is volatility forces banks to have these hedge funds post more collateral for the basis trade they're doing on immense amount of leverage buying all these treasuries. And so as soon as the bond market got volatile, that's why you saw all the financial authorities step in and say, we're here to protect it, because they almost blew out the only person that's price insensitive and willing to buy this piece of crap debt. So where I see the market today is the Treasury. Bessent goes on Bloomberg immediately. I'm going to organize stock buybacks. Jamie Dimon comes out and says, let's please change the supplemental leverage ratio so banks, US banks, can buy unlimited amounts of treasuries, right? You're seeing support for the treasury market. We're going to kill volatility. We're going to print the money, and capital flows of our trade partners get it out of the US so we can build a middle class again. We can build a manufacturing class again. And China and Russia, all of these countries with all these large trade surpluses, are going to have to find a place to store and protect their capital. And I think gold and Bitcoin are going to be the winners in this decade.
After World War II, the United States emerged as the dominant global economic force, holding the most gold, boasting the strongest manufacturing base, and anchoring the world with the US dollar as the reserve currency. In exchange, the US imported goods and exported dollars, creating a global system that drove decades of growth. But there was a trade-off. This model also laid the foundation for persistent trade deficits and mounting national debt. Over time, the cracks started to show, and now the US is beginning to reject that legacy. Enter the Trump-era approach, blunt and direct. China, take your money and go home. The message is clear. The old rules are being rewritten, and economic nationalism is back on the table. The global financial system is shifting, and understanding the roots of that change is key to navigating what's next. If you found this perspective eye-opening, be sure to like, subscribe, and turn on notifications so you don't miss future deep dives into the forces reshaping our economy. What's your take on the US shifting away from its post-WEPA II economic playbook? Let us know in the comments. We're all ears. Let's go back to the interview.
So the buyers of US debt, those that are actually lending to the United States to allow them to finance themselves out of this hole, are hedge funds. And what these hedge funds are doing is what's called a basis trade. And the way that this works is they're arbitraging US debt instruments, but they're doing it on an incredible amount of leverage. You know, imagine a hedge fund making just a millimeter worth of money, but if you can lever that times a million, you can actually make a lot of money. So leverage is the game. Leverage does not work in a very volatile market because that person lending you the leverage is going to ask for more and more collateral. The hedge funds don't have the collateral. They close their positions. The bond market gets absolutely obliterated. That's what we saw post-Liberation Day. And so what Jamie Dimon, what Scott Bessent have been advocating for in the media is give this market more leverage. Something like the SLR, the supplemental leverage ratio, that was introduced after 2008, the great financial crisis, because what the new regulation said is banks can't just infinitely leverage their balance sheets to buy US debt. You need to post some sense of equity, some sense of capital. It has to be expensive for you to lever yourself that much. It applied some physical constraints to the market so that it couldn't get so irrational. And what these financial leaders are asking for is let's remove those rules. because we're going to need a lot of leverage, and we're going to have to support a lot of these market participants like hedge funds that are running an arbitrage trade. They're not necessarily speculating on US debt. The US wants buyers of these instruments that don't care about the price. They're just arbitraging. And so when Scott Bessent, and I encourage everyone to go look at his interview where he talks about Treasury buybacks. I encourage everyone to go where Jamie Dimon says, remove the SLR. This would allow banks to infinitely buy US debt, unlimited amounts of leverage. It's going to allow these hedge funds to use unlimited amounts of leverage. And so that's what you're going to get is you're going to get an insanely levered, which it already is, US financial system, and buyers like US banks and hedge funds in the Cayman Islands that are running either arbitrage trades. I mean, these guys don't care about the fact that the United States is going to have real rates negative. Inflation is going to run hotter than the yields. And so that's my opinion. And they can't sustain any volatility. So they're going to have to print the money. And that's all very, very inflationary. And all this new capital is going to have to find something that can actually protect it. And I believe Bitcoin's the ultimate winner because it's the hardest thing you can own. Hard as in it's the hardest to make more of it. It's the scarcest thing you can own. And that's who I think is the winner in a world where fiat is so increasingly abundant. I think they're both rallying together. I think capital is flowing into gold from trade surpluses. So I've hinted at this post-World War II alignment. Let me just, if you don't mind, storytell for a second.
Please.
So really what happens at a decimating world war, the US was the strongest economy. They owned the most gold. They had the best manufacturing base at the time. And so what they did is they exported their strength by taking on the world reserve currency status. What they told the world is, listen, let's make the dollar the world reserve currency. We got the most gold. We have the strongest economy. We'll export our strength to you through the dollar. You all produce stuff. So Russia, you're the best natural commodities producer. China, you're going to build on top of manufacturing. Germany and Japan, you're going to see lots of growth. So the US structurally operated in a deficit. We didn't produce. We let everyone else produce. We exported the dollar. We imported goods and debt, right? So we imported food, energy, oil, manufactured good, cars, and we exported the dollar. Now, that's not a very sustainable practice, printing pieces of paper for real stuff. Mm-hmm. That was a reaction to a world war. But like any other empire, in my opinion, the US has gotten greedy. Those deficits have compounded over decades, over decades, over decades. The debt has compounded over decades, over decades, over decades. Now you live in a world where China is operating in $1 trillion plus annual surplus with trade, global trade, and the US has over $35 trillion worth of debt. And my opinion is we're just unwinding from this very irrational economic behavior that was never supposed to scale in the first place. We're unwinding from the world wars, where the new US policy published on February 21st was China, take your money and go home. China's taking their $1 billion trade surplus, Jeremy, and you cannot invest it locally. You cannot strengthen the local Chinese currency. It weakens your export market. So you have to invest it outside. So the reason US exceptionalism, US tech stocks only go up is they were getting a lot of the capital flows from global trade surplus. China's taking their $1 trillion. They're plowing it into US real estate. They're plowing it into US tech stocks. Trump's new policy is you're creating a wealth gap in this country. You're destroying the poor. You're creating too much asset inflation. We don't want your money here anymore. Take your money, go home. If you're China, okay, Treasuries is a bad place to put capital. Mag 7 is a bad place, and now we're not even allowed to put capital in it.
Capital flows are on the move, and the shift is seismic. Trade surplus countries like China and oil-rich nations can no longer recycle their US dollars into tech stocks or treasuries the way they used to. Those once reliable avenues are narrowing, and global capital is looking for new places to park and protect itself. That's where gold and Bitcoin come in. But here's the key difference. Bitcoin isn't just reacting to inflation, it's anticipating it. It's the hardest asset in the world to inflate, the most decentralized, and the most liquid across borders. In a global landscape where every other asset is increasingly politicized, Bitcoin stands alone, neutral, unconfiscatable, and borderless. The capital shift is happening right now, and those paying attention are positioning accordingly. If this resonates with you, do us a favor. Smash that like button, subscribe, and turn on notifications so you don't miss more insights like this. Have thoughts on the capital flight toward Bitcoin and gold? We want to hear them. Drop your take in the comments and join the conversation. And make sure to check out the other videos on our channel to stay sharp on everything from crypto to macroeconomics. Thanks for watching, and see you on next video.